All right, let's get right into it. We're going to do a deep dive today on one of the most maddening situations in tax compliance, what I call the no EIN trap. If you're a practitioner and you've had a client with settlement income, you know exactly what I'm talking about. It can be a real nightmare.
So here's the core problem, right? Your client has a check. It's taxable income. They want to do the right thing, report it, and pay their tax. But the payer, who's usually some settlement administrator, flat out refuses to give you their employer identification number. And that one little piece of missing information can bring the entire e-filing process to a screeching halt.
Okay, so here's how we're going to tackle this. First, we'll lay out the paradox itself. Then, and this is crucial, we'll talk about how to characterize the income. After that, we'll look at the technical deadlock, go through the practitioner's playbook of workarounds, brace ourselves for the inevitable IRS matching notice, and then wrap it all up with a solid, strategic roadmap.
First things first, we have to understand what makes this a paradox. This isn't just a small snag. It's a fundamental conflict between the taxpayer's legal duty to report every dime of income and the payer's decision to withhold the very data you need to do it electronically.
And this is where it gets so tricky. You've got two valid but completely opposite positions. On one hand, you have the claimant. Internal Revenue Code Section 61 is crystal clear. You have to report all your income. But the tax software we all use, it's hardwired to IRS rules. No payer EIN for 1099 income means no e-filing, period. On the other hand, you have the administrator. They have a duty to protect the fund. Handing out their EIN to potentially thousands of people, well, they see that as a huge security risk, opening the door to fraud. Both sides have a point, and that's the trap we're stuck in.
So, with the problem laid out, we can get to the first step in actually solving it, and that is correctly classifying the income. Before we even think about how to report it, we have to figure out what kind of income it is, because believe me, your entire strategy depends on getting this right.
The key here is a legal concept called the origin of the claim doctrine, which comes from a big Supreme Court case, United States v. Gilmore. Basically, it means you have to look through the settlement and ask, what is this money replacing? Was it for lost wages, punitive damages, lost business profits? Answering that question is always step one.
And this is a major fork in the road. If the money is replacing something like back pay, it's treated as wages under IRC Section 3401A. And for that, the law gives us a specific tool, Form 4852, which is a substitute for a W-2. That's the authorized proper way to do it. But, and this is a big but, if the payment is for non-wage stuff like punitive damages, there is no official substitute Form 1099. Using Form 4852 here is a procedural hack. It's not what it was designed for, and that puts you in a very risky position.
Now, the entity you're usually dealing with in these cases is something called a Qualified Settlement Fund, or a QSF. Under IRC Section 468B, a QSF is its own legal entity. It's not the defendant, it's not the claimant. For tax purposes, it's basically treated like a corporation.
And this is where you can see the QSF's conflicting duties. It has to get its own EIN, it has to file its own tax return, a Form 1120SF. And according to IRC Section 6041, it's supposed to issue a 1099 MISC to claimants. But at the same time, its main job is to protect the fund, which leads them to lock down that EIN and refuse to give it out.
And just to make things more complicated, there is a change on the horizon that could make this problem even bigger. Currently, the reporting threshold is $600, but there's legislation that would raise this to $2,000. Now, think about that. A client could get a check for, say, $1,900. That's still taxable income they have to report, but under the new rules, the QSF wouldn't have to issue a 1099 at all, which means there's absolutely no reason for them to provide an EIN, making this compliance gap way, way wider.
Okay, so this brings us to the actual deadlock. This is where all that legal theory slams into the hard reality of tax software and how the IRS actually processes returns.
For anyone using professional tax software, the first thing you hit is a brick wall. The software is built to the IRS's e-filing specs, the MEF schemas, and those rules demand a 9-digit EIN for any 1099 entry. If you leave it blank, you get a fatal error and you are completely blocked from e-filing.
So you think, fine, I'll just paper file. Well, not so fast. When you do that, the return gets kicked into the IRS's manual processing system. The Internal Revenue Manual itself tells us what happens. The return is suspended, it gets sent to a human being in entity control to be researched, and here's the kicker. This whole manual process is a guaranteed way to get your client's refund frozen. So even if you file perfectly on paper, you're signing up for a major delay.
So what's a tax pro to do?
Well, over time, we've developed a few workarounds, but each one comes with its own set of risks, and it's really important that we understand them.
The most common workaround, which I call the nuclear option, is Form 4852. Now, its legitimate use is as a substitute for a missing W-2. That's what it was made for. But using it for non-wage 1099 misc income, that's totally off-label. It's a hack to force the system, and it creates a data mismatch that the IRS computers will definitely notice.
And you don't have to take my word for it. Tax experts like Robert W. Wood are very clear on this. Using a Form 4852 to incorrectly argue that income isn't taxable is considered a Tier 1 frivolous argument. The IRS actually has this on a list of known tax protester tactics.
And the risk isn't just getting the return rejected. We're talking about a specific $5,000 penalty under Internal Revenue Code Section 6702 for filing a frivolous tax return, and misusing a Form 4852 is a known trigger for that penalty.
So, what are these safer plays? Well, the best strategies completely bypass the 1099 input screen. For non-wage income, you can report it on Schedule 1, Line 8, as other income, no EIN required. For lost business profits, it goes on Schedule C as gross receipts, which also correctly calculates the SEE tax. And the last resort is to paper file, but write refused in the EIN box and attach a very clear statement explaining why.
Now, just because you filed the return doesn't mean you're out of the woods. You have to remember that the IRS's computer matching program, the AUR, runs on a very long delay. Think of it like a really long fuse.
And this timeline really shows you what I mean. Let's say you file the return in April of 2026. The IRS computers don't even start matching the 1099s to returns until late 2027. This means that CP2000 Notice, the one that says your client underreported their income, probably won't even show up in their mailbox until early 2028, a good 18 months after you filed.
When that notice does arrive, the #1 rule is don't panic. A CP2000 is not an audit, it's just a computer-generated mismatch notice. You have to respond on time, and you simply explain that the income was reported just on a different line, like Schedule 1. Use the settlement statement as your proof. And importantly, the fact that the payer refused to give you an EIN is a fantastic reasonable cause defense to get out of that 20% accuracy penalty. Okay, let's pull all of this together. We're going to distill all these technical details into a clear, strategic roadmap that you can actually use in your practice. Think of this as your cheat sheet. It's a decision matrix for the most common situations. If it's back wages, the safe, legitimate path is Form 4852. If it's punitive damages, the safe harbor is Schedule 1, other income. For lost business profits, it's got to go on Schedule C to handle the self-employment tax. And never forget the first question you should always ask. Was this for a physical injury? If so, under IRC Section 104, it's probably tax-free and doesn't get reported at all. And that leaves us with one last big picture question. This whole no EIN trap isn't just a random glitch. It shows a real crack in the system, a deep friction between our highly automated tax system and the messy, complex real world. So as we keep moving towards more automation, we have to ask, how do we build a system that can still handle these legitimate edge cases, where a little bit of human judgment and professional nuance isn't just helpful, but absolutely necessary?